Hi candidates, welcome to another session of manifested online classes. So in this session, I want us to continue with more illustrations on the topic of deferred tax. And specifically, I want us to look on another question for deferred tax, which equally incorporate the concept of group accounts. And the question is for September 2021, specifically question number 3, Roman 1, and also Roman 2. So we start with Roman 1, which was a theory. It reads, with reference to deferred tax, differentiate between permanent difference and the temporary differences. So what the examiner was requiring, you differentiate two terms there, two terms. That is what referred as the permanent, differences and the temporary differences. So basically, to differentiate, you just define what is permanent difference and what is the temporary difference. First of all, when we talk about the permanent difference, we say that these are difference which give rise to a difference between accounting profit and taxable profit. And that particular difference arises as a result of taking into account items of incomes and expenses in computing the accounting profit, but those particular items are not taken into account in computing the taxable profit. Now, good examples of such items include something like depreciation. We know depreciation is an expense in computing the accounting profit, but depreciation is not considered as a allowable expense in computing the taxable profit. Another good example of such an item is fines and penalties. Fines and penalties are accounted for by the company as an expense in computing the accounting profit, but those particular items are not treated as a allowable expense in computing the taxable what? Profit. So that is a kind, or those are the items which give rise now to what referred as the permanent what? Difference. So we can say that a permanent difference is the difference between accounting profit which is also known as profit before tax, and the taxable profit which arises as a result of taking into account certain items of incomes and expenses in computing accounting profit and not in computation of taxable profit. And I've given good examples of such items of incomes or expenses which will only be considered in computing the accounting profit, but not considered in computing the taxable profit. So such items include depreciation. We also have the fines and penalties, etc. And therefore, what we say is that this particular difference here, that is the permanent difference, is basically a difference between accounting profit and taxable profit, which only arises in a certain accounting period, but that difference do not reverse in the future. And therefore, this difference between accounting profit and taxable profit is totally ignored for the purpose of computing the deferred tax. In other terms, this particular difference here do not give rise now to the deferred what? Tax. So that is the first thing which a candidate was expected here. Explain what is permanent difference, and then from there we need to explain what is temporary difference. Temporary difference, this one is very simple because this is just the difference between the carrying amount and the tax base of asset and liabilities. So we can say that the temporary difference, which is abbreviated as TD, is the difference between carrying amount and tax base of assets and liabilities. The difference between the carrying amount and the tax base of what? Asset and liabilities. And also in this case, we have two types of this. We have two types of temporary difference. First of all, we have something called the taxable temporary difference and deductible temporary difference. Taxable temporary differences arises whereby the carrying amount of various items of asset and liabilities is more than tax base, but a temporary difference will be deductible if the carrying amount of various items of asset and liabilities is less than the tax base. Base. So that is it. That what was required in Roman 1 of that particular question. So basically, by the candidate doing that, a candidate was supposed to get 4 marks automatically for explaining a permanent difference, 2 marks there, and for explaining what is a temporary difference, equal to marks there. Okay, so then we have Roman 2 of that particular question. That was Roman 1. So Roman 2, let's go through that information. You see what was being required. We are told Huruma Limited, a public limited company, has a portfolio of investment, including various subsidiaries, and also undertakes various projects varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statements relating to the deferred tax provision for the year which ended 31st of March 2021. So we have that information, number 1, basically up to note number 6. We are going to go through that as we see what the examiner was requiring. So what we are required is to determine the amount of deferred tax asset or deferred tax liability of Huruma Group as at 31st of March 2021 in conformity with International Accounting Standard number 12. So what we are required to do here is to compute the amount of deferred tax asset or deferred tax liability, and automatically for us to do that, we have now to determine whether at the end of this particular financial year was there a net taxable temporary difference or was there a net deductible temporary difference. For us to do that, it is obvious that we have to prepare something called the schedule of temporary difference. We compute the temporary difference of each of the item which is given there from note 1 up to note 6, actually to note 5, and then from there we determine the net amount of a temporary difference, which will either be a net taxable or net deductible temporary difference. But what the examiner here was requiring is for the candidates to determine the amount of deferred tax, the deferred tax asset or liability, stroke liability at the end of the year, which ended 31st of March 2021. So in this case, I've said for us to do that, to do this, we need first of all to determine the temporary difference of those items, and then at the end of the year, or basically by the end of the day, we determine whether we have a net taxable or deductible temporary difference. So we do that by preparing something called a schedule of temporary differences. So in our schedule here, we need to have various columns. The first column here will be for the various items of assets and liabilities as provided there, which is in million of shillings. So then we have the other column here, which should be for temporary difference, for tax base, abbreviated as TB, tax base. And the last column here is for TD, temporary difference. And equally, these will be in million of shillings. So we need to go through the items we are given from note 1 up to note 5 so that we can be able to compute their temporary difference, and then by the end of the day we get the net amount. So what you're given or we are told in note 1 is that Huruma Limited acquired a controlling interest in a subsidiary, Shukari Limited, on 1st of July 2020, that is within the current year. The fair value of the asset and liabilities acquired were considered to be equal to their carrying amount, with an exception of freehold property, which had a fair value of 256 million and a tax base of 248. So I think that one is straightforward because we are given an item of freehold property. And for that item, we are given its fair value. The fair value, this is the amount at which this item will be recorded in the statement of financial position, meaning that is the carrying amount. And then also we are given the tax base, which is 248. So no problem with that because the two values are provided. We are told the directors have no intention of selling the property, meaning that it will be accounted for as an asset, as a non-current asset, that is. So we get the difference, 256 minus 248, 248, that will give us a difference of 8 million, which is a positive, and therefore that is a taxable temporary difference. So we move to number 2. We are told during the year which ended 31st of March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, which is called Wingu Limited, and made a profit of 16 million on the transaction. And then you're told 40% of these goods were held in the inventory of Wingu Limited as at 31st. So in such a case, what you just need to do is to determine the goods which were not yet sold at the end of the year. You determine their cost, which will be the carrying amount, and then their selling price will be the tax base. So therefore, we have inventories. And for these particular inventories, we need to determine their value. And basically in this case, we are told the goods which were sold by the parent to the subsidiary had a value of 48 million. And then we are told in the last sentence, the goods which were not yet sold at the end of the year, they had a value of, or basically they were 40%. So what we need to do is we get 40% of 48, 40% of 48, which will give us 19.2. So remember 19.2, and this is basically now the cost. This is a cost now to the buying company, and therefore when buying company is preparing its income statement, this what it will consider. This what it will take as the cost of the goods which were purchased. In other terms, this is the tax base. So the tax base in our case is 19.2. What about now the carrying amount? So this particular inventory will be taken to the group statement of financial position at this value here, that is 19.2, but minus the unrealized profit. So how do we compute the unrealized profit? The unrealized profit in this case is equal to the profit which was reported by the selling company, which you're told was 16 million. And because 40% of these goods were not yet sold, meaning that the profit not yet realized will be 40% of that profit, 40% of 16 million, which will give us 6.4. So therefore, to get the carrying amount, or the amount at which this inventory will be recorded in the group statement of financial position, we take 19.2 minus the unrealized profit of 6.4. 6.4. So this will give us what? Okay, so we have 19.2 minus 6.4. Yes, so that will give us 12.8. So this is the carrying amount of that particular inventory. So we get the difference, which is this value 12.8 minus 19.2, and that will give us a 6.4 million, which is basically a negative figure, and therefore this is deductible temporary difference. So let's move to the other point there, point number 3. So we are told the Huruma Limited has a portfolio of financial assets comprising readily marketable government securities, which are held as current asset for financial trading purpose. This investment are stated at fair value in the statement of financial position, with any gain or loss taken to profit or loss, and we are told the gain or losses are taxed when the investment are sold. Currently, the investment have a market value of 412 million and accumulated unrealized gain of what? 64. So basically what here given there is financial assets which are held by the company for trading purpose. And financial assets which are held by the company for trading purpose, they are known as financial asset at fair value through profit and loss. That is abbreviated as FVTPL. In full, financial asset at fair value through profit and loss. Now, this particular financial asset at fair value through profit and loss, in the company statement of financial position, they are stated there, they are recorded there at their current market value, at their current fair value, which you're told is forward 412. But now their tax base is always equal to the cost. Now, what you're told is that this particular fair value or market value of 412 million is arrived at after the company has added total accumulated gains over 64 million. So therefore, in terms of how we get the cost, which is the tax base, we take the fair value minus the accumulated revaluation gains. So this will give us now the cost, and which you are saying is what? Is the tax base. So this will give us 348 million. So therefore, that is the tax base here, 348 million. So let's get the difference. Let's get the difference here. The difference will be what? The difference here will be 64, which is a positive figure, meaning that it is a taxable temporary difference. So we are done with that particular point. Let's move to point number 4. And you're told Huruma Limited loan assets had a carrying amount of 168 after allowance for credit losses of 32 million based on 12-month expected credit losses. Tax relief is only allowable when the specific loan is written off. Specific loan is what? Is written off. So we have something called the loan assets. The loan asset. So when talk about the loan assets, these are like the loans this company has given to its customers. So the loans given to its customers. So we are told these loan assets, they have a carrying amount. That carrying amount is already given of 168, but you are told this 168 was arrived at. This was arrived at after the company had made a provision of 32 million. 32 what? Million, which you are told generally is allowance for credit losses. What is allowance for credit losses? The company from these loans it has given, the company expects loans equal to 32 million will not be paid. Therefore, what the company has done is to create a provision to set aside an amount of 32 million to cater for those particular loans which will not be paid. But we are told that tax relief is only given to this particular company once specific loan is written off. So because this is just a general provision, so what we need to do for us to be able to get the tax base, we need to take the carrying amount and then we add back this amount which had been what? Deducted. That will give us 200 million. That will give us 200 million, which now will be our tax what? Base. So we take this minus that, which will give us 32 and basically a negative, and that is deductible temporary difference. Okay, so then let's move to the other point, which is point number 5. And you're told Huruma Limited has a unrelieved trading losses of 20 million as at 31st of March 2021. So these are like losses which were reported by this company during the current year. And the reason why they are known as unrelieved trading losses is because once a company has reported losses, those losses should be carried forward to the next financial year and offset against the profit which will be made in the following financial year. So because they have not been offset against now the profit reported in the previous years, that's why it is known as unrelieved trading losses. So we are told these unused tax losses arose from a one-off restructuring exercise carried out during the financial year, and which is highly expected that taxable profit will be available in the future. So meaning that this particular amount of 20 million will be carried forward and will have now to be offset against the future trading profit. The future trading what? Profit. So we also need to take into account that here, and basically we can just refer to that as what? As the unused tax losses, unused tax losses. So these unused tax losses, are they taken to, or are they recorded in the company statement of financial position as an asset or liability? No. And therefore, the carrying amount for this is equal to 0. Once the company reports losses, those losses are not taken to the balance sheet as an asset or as a liability. So mean that the carrying amount is 0, because the carrying amount is a value at which an asset or even a liability is recorded in the balance sheet. But we know that this particular amount of 20 million will have now to be carried forward by the company, and it will have to be offset against now the future taxable profit. So therefore, the tax base of this is 20 million. Is 20 million. So we take this minus that, which will give us negative 20, and which is still deductible temporary difference. Yes, I think we are done, because what you're given in note number 6 is about the tax rate, and also we are told to assume that the deferred tax account had nil balance at the start of what? Of the year. So what we need to do here is we get the net amount. So we have 8 minus 6.4 plus 64 minus 32 minus 20, which will give us 13.6, and which is a positive figure. 13.6 million, and take into account is a positive figure that will be known as the net taxable temporary difference. And therefore, because this is a net taxable temporary difference, it will give rise to something called a deferred tax liability, and that is basically what the examiner was requiring us we compute what here. So therefore, the deferred tax liability at the end of the year, that is on 31st of March 2021, this one will be equal to the net taxable temporary difference, what we have here, times the tax rate. So our net taxable temporary difference is 13.6 million times the tax rate. So in our case, if we go back to the information we are given in note number 6, we are told to assume the tax rate or the corporate tax rate applicable to this company, 30%. So we get 30% of that figure. 30%, 0.3 times 13.6, which will give us 4.08 million. So this is now the amount of what? Of the deferred tax liability at the end of the year. At the end of what? Of the end. Basically, the marks or the items now which are marked in such a question are these figures which you have here, and also computing that particular what? Amount of deferred tax liability at the end of the year. Basically, a candidate who was able to do that, such a candidate scored all the 8 what? Marks which were allocated in that particular question. Basically, that is it. That what is required as far as that particular question is concerned. A very good question on deferred tax, which incorporate a lot of concept or a lot of group accounting concept. So we stop at that point. See you in the next session as we still look on another illustration.